Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The U.S. stock market is at new highs, but international flows, they're all over the place. There's been huge inflows into India and Japan, which has reinvigorated overseas investing. But China flows are flat to down as that market hits multi-year lows. Here to make sense of it all is Dave Mann. He's the global head of products and capital markets at Franklin Templeton, and Mike Akins is from ETF Action. Gentlemen, thanks for joining us. Dave, you oversee Franklin's ETF business, including the India, Japan, China ETFs. Talk to us about India and Japan. Why are these both so hot right now?
Yeah, sure. Thanks, Bob. No, I think one of the nice things about the ETF vehicle is you can get target exposure to lots of different things, and specifically what we've seen over the last year is investors looking to ETFs to get single country exposure. One of the hottest countries was India. Our fund FLIN brought in about 600 million over the last year. Part of the growth story, GDP has been strong. A lot of the middle class starting to invest more has been one of the emerging market standouts thus far. So India has been a great story. Japan is always almost like its own region, if you will. So we've seen lots of inflows into FLJP. That's our Franklin Japan ETF. But just more broadly, lots of investors looking to get exposure to those single countries.
Yeah, and I see some names we know very well here in the United States in the India ETF, Infosys and Tata, of course, have been around a long time. India, though, has emerged as the obvious global manufacturing competitor to China. But wouldn't you say, Dave, it's a long way off from really competing against China? I guess that's the sort of concern that I have here about just let's throw all our money into India as an anti-China play.
Totally, yeah. This is definitely the call it the early innings, but just in terms of without getting too far into politics, the mix of call it the democracy, although a messy one, is getting a lot of people to pay attention to India as a long-term emerging market play. Yeah.
Mike, your thoughts here on what's going on with India and Japan as well. I see in Japan, I see a lot of these names in Dave's ETF that we all know: Toyota, Sony, Mitsubishi, Hitachi. These are names we all know very, very well. What are your thoughts on the inflows here that we're seeing?
Yeah, I think the biggest takeaway is just with the ETF vehicle, it's a great way to get targeted exposure to these countries. I mean, there's over 153 ETFs that track single countries. $100 billion in those markets, and it's very fast-moving money. It's a lot like the sector ETFs. It's a great way to have a macro play. If you look at India, I think there's definitely a story to be had with regard to a new manufacturing hub versus China, but also just the GDP growth story in total. I do think investors should be wary of valuations in that area. If you just look at the India ETFs, they're trading right now anywhere from 22 to 23 times next year's earnings. That's extremely elevated to the most foreign ETFs and very elevated to itself. 10-year average being closer to 18, whereas China is just the opposite, right? It's got a 10-year average PE of 11. Currently, most China ETFs are trading below 8. So there's a story there to be had with respect to the growth, but the market has reacted, and all those inflows have driven up those valuations. So it's something to keep an eye on. But I think it's definitely a macro play. Anytime you see that money flowing in and out of these ETFs, it's a great way to get sentiment about those countries. Japan obviously has got a very stated pro-growth mindset right now after years of stagnation or deflation, and that also has driven a lot of information. One thing I would point out with all of these ETFs, there's two ways to play it in the country ETFs. There's usually a currency where you have exposure to that risk of the FX of that country, and there's the currency hedged. And you're just using the Franklin ETFs, FLJP, as well as the Franklin Japan hedged ETF. I believe the hedged ETF more than almost doubled the return of the non-hedged. So big difference in returns, and you got to understand that currency exposure as it comes to the two different types of strategies.
That's a very important distinction, and I'm glad that you made that. What's amazing to me is just that Japan is a story at all. I was hired, this is my 34th year at CNBC, believe it or not, and I was hired in 1990. That was the peak. I think Mitsubishi owned 30 Rock at the time. They owned Pebble Beach. And literally it's been stagnating for 30 years. And I'm pleased to see finally something is happening and investors are taking notice and the people managing the country are taking some more pro-growth policies. But darn, it's taken a long time, you know? So I think it's as big a story as the India story was last year on top of that.
Absolutely. I think Japan is an interesting story, just in terms of how much exposure they have across globally, similar to the U.S., but their valuations are so much more depressed, you know, trading at 14 times next 12-month earnings. There's definitely a story to be had for Japan. I'm a little more weary on India, not because I don't think it's a great growth story, but it's got some of the complications that China has. You know, if you look at China, and the growth of GDP of China over the last 20 years is, you know, 10x, 13x, but the stock market is flat to down. I think you have to understand those different variables at play. The stock market is not the economy. So Japan, to me, seems a little bit more, well, conservative play, if you will, when it comes to the unknowns.